We call it a bear call spread. Different types of spreads. We've got vertical spreads, calendars, diagonals. But in general, a vertical spread is where we're buying one option and we're selling another option against it. Now, we can sell other assets against it, et cetera. So we can buy option and sell stock, for example. That technically is a spread. But with the vertical spread, we're buying one option and selling another, different strike prices, all within that same expiration date and obviously the same product. The two main types of spreads, we have debit spreads and credit spreads. A debit spread is just like any other thing that's a debit, right? You're paying money for it. And when we buy options, we are buying the right to do something. When we sell options, we're incurring the obligation to do something. So with a spread, whether it's a debit or a credit, where we're buying one option and selling another, we have both rights and obligations at the same time. With a debit spread, we're paying to initiate that position. When we buy something, we are in control. So when we're doing a debit spread, for example, we control how that spread kind of plays out a little bit. The market may have a different opinion of how it turns out, but at least we have some degree of control when we're buying. When we're selling, we're collecting that premium. That's going to be the income that we're generating from that particular strategy. We're receiving that premium when we initiate our position. But again, we're buying one option and selling another, so we still have those same rights and obligations. So credit spread, we receive that premium to initiate the position. Again, we're long one option, we're short another. We've got rights on the one hand, obligations on the other. Now, when people trade call credit spreads or a bear call spread, they're bearish, right? It's a bear call spread. So your initial leg is going to determine your forecast for the spread. We might be neutral, we might be bearish with this bear call spread. Remember, when we're selling options, that premium is ours to keep. The way that we keep it is for that contract to theoretically expire out of the money and expire without value. So when we buy options, we need something to happen. We need the market to move. We need implied volatility to change. There needs to be some impetus in the market, some reaction to change the value of the contract that we just purchased. Because if we bought it for $2, we need it to be worth more than $2 at expiration in order for us to realize a profit, right? That just generally makes sense. When we're selling options, we want the opposite to happen. We either want the market to stay as it is, right, neutral, or we want it to perform the way that our direction wants it to perform. If we're bearish and we're talking calls, we want the market to do what? Go up or down? Up or down? There we go, thank you. So we can be neutral because that contract can still expire without value, even if the market doesn't move, and we're okay with that. Because when we sell options, the most that we can make is the premium that we collect. So we're not necessarily concerned with the market dropping with a bear call spread. What we don't want is for the market to go up. But again, with the flexibility of options, we can pair that short call, that bearish call that we're selling, we can pair that with a long option just in case, right, for protection. When we sell a call by itself, we call it a naked call, and it's the most risky trade out there, right? We are obligating ourselves to sell stock at our strike price, and I'm talking equity options. Certainly you could trade these with ETF and indices as well, index options. But with an equity option, when we sell a call, we're obligating ourselves to sell that stock at the strike price. Well, if we're selling a $50 call and stock rallies up to 500, it's probably not going to be very good for us. We're not going to be long-term traders by making trades like that and losing money like that. But what we can do, and the reason that a lot of people trade spreads, is to have that protection. We still want to generate that income by selling the contract, but we also want to buy some protection should we turn out to be wrong. All right, I'm assuming nobody ever here has been wrong on a trade before, right? We don't need that protection. So investors, whether it's a market maker or hedge funds or individual investors, they will take their forecast of the market and choose a strategy based on that forecast, but they may also protect themselves in case things don't go quite the way that they hope to. And that's what we have with the bear call spread. So our first iteration is going to be we're selling that call because we're bearish on the market, we think it's going to go down, or we think it's really not going to move very much, and we want to collect that premium. But just in case we're wrong, we want to have that protection. So we've got defined risk and reward, right? We know how much we can make because we're selling. So the most we can make is that premium that we collect. That's going to be our defined reward. And our defined risk, in the case with this, is going to be the difference between the two strikes, which I'll get to in just a moment. But the reason that people trade spreads is that defined risk and reward, we've got a more favorable break-even point, right? When we trade spreads or when we're adding more legs to the option, it changes the cost basis of our trade. It changes our break-even point, changes our profit and loss scenario. Risk control, again, that defined profit potential. We know how much we can make. We know how much we can lose. But when we have option trades, it's different from stock. There was somebody that I was speaking to earlier today, and I was explaining how stock, for example, a lot of times you just kind of buy it and stick it in the drawer and forget about it. Option traders, whether it's a spread trader or if you're just buying and selling options, it's a more active type of investment, right? You need to monitor the position. You need to be engaged. I was speaking with a family earlier that they're getting their son started in the stock market and saying that they're buying stocks, for him and, with the idea of just kind of putting it away and kind of forgetting about it. And then we were talking options. And I said, well, you certainly aren't going to want to do that with options, right? You need to be an active participant. Investing with options is an active participation type of investment. So we were talking about that. So this last bullet point here, position monitoring, critical. You always want to be on top. You always want to know what's going on with your position. Let's go ahead and look at an example of what a credit spread is or a bear call spread, and it might help drive the point home a little bit easier. So here's our favorite stock, XYZ, trading $87.50, and we're going to be using this example throughout the presentation today. We've got 28 days till expiration, right? So about 4 weeks. We think that our stock is going to stay somewhat where it's trading. It's trading 87.5. We don't really see that it's going to move to the upside all that much. And if it moves lower, well, all the better, right? Because we're bearish. We want it to go lower. We think it's going to go lower. So we go ahead and we look at our options chain and we see, for example, a $90 strike call for 28 days. We can sell it for $3.50. Now, that might be enough for you right there, right? You're bearish. You think the stock is going to go down. You can collect, $3.50, $350 per contract, put that in your pocket and be happy and hope that the market performs as your forecast dictates, right? You think it's going to go down. That should be a lot easier to say than it was. But what if you're wrong, all right? What if it doesn't go down? What if it goes up? Instead of going to $80, it goes to $800, right? That's going to be a big problem. So we're looking for protection. We're going to buy this long leg, which in this case is the $95 strike. We're going to buy that for $1.80. So we're giving back some of that premium that was really the whole point that we wanted to do the trade, right? We were looking to generate that income. We did with selling the $3.50 call. But in case we're wrong, it could cost us a lot more than that $350 that we collected when we did the trade. So to protect ourselves, we're going to buy that extra leg, the $95 strike. So just in case things don't go right and they go the exact opposite of what we want, we've got that upside protection. So we have now in place a $90, $95 bear call spread. Again, we're neutral to bearish. We want the stock to go down. Ideally, we don't want the stock to go up. That's really more of a situation. Neutral. We don't care if the stock goes down. We don't care if it stays the same. What we don't want it to do is go up. So our forecast is still neutral to bearish. Here's our trade. We've got the $90-$95 call spread. We sold it for a net credit of $1.70. It's $170 in our pocket. That's going to stay there regardless of what might happen with the trade. That's also going to be our maximum gain. Anytime we sell options, remember that premium we collect, that is the most that we can earn. And even though with a bear call spread, we sold an option and bought it, the net outcome is a credit, hence credit spreads. That's why we call them credit spreads. So because we're a net seller, that premium that we collect, that net premium, that's going to be our maximum profit. Our maximum risk is going to be the difference between the strikes minus that premium that we collected. Our margin on the trade, that's going to vary from broker to broker, but typically it's going to be equal to the risk that we're taking on. And our break-even point is going to be $91.70. We figure that by our short call, if we were forced to sell stock at $90, because that's where we're short, but we collected a $1.70 premium when we initiated the trade, theoretically we're actually selling that stock at $91.70. So that's going to be our break-even point. Anything below that, we're going to be profitable. Anything above that is where we're going to begin losing money. And I'll graph that out for you to show it a little bit more visually for you. Here's our trade. Our maximum profit, $1.70. Maximum risk is going to be $3.30. And here is, if you can see my pointer, there's our short $90 call. You can see when stock goes anything below that, 85, 80, whatever, you see that line is straight, right? That's going to be our maximum profit. It doesn't matter if stock drops to zero. We're not going to be able to make any more than that $170 credit. Our maximum loss, again, it doesn't matter if stock goes up to 100 or more because we are long that $95 strike. So if stock finished at 100, this would expire worthless. Let me rephrase that. It wouldn't expire worthless. This short call would get assigned. We would be forced to sell our stock at $90. This long call would get likely exercised. We would buy those shares back for $95. So we sold it at 90, we bought it back at 95. That's a $5 loss on the stock minus the $1.70 premium that we collected up front. That's going to be our $3.30. That's going to be our maximum loss. So it doesn't matter if stock goes to 1,000. We can't lose more than that. And I kind of explained it a little bit the same here. If shares finish at or below the short strike, it would be expected that both legs expire unexercised and worthless. If shares finish $50, then I'm not going to be exercising my long call and buying stock at 95. Certainly not going to do that. That option expires worthless. My short call at 90, nobody is going to force me to sell them stock at $90 when it's trading 45 or 50 in the market, what have you. So that leg's going to expire worthless. The trade simply expires without value. No exercise, unlikely assignment. That premium that we collect, that $1.70, that's going to be our max profit. We retain 100% of that. If shares finish above the long strike of $95. Our long call would exercise. We would buy shares for $95. We're still obligated to sell that stock at $90, right? So our short call would get assigned, and we lose $5 on the stock minus the premium that we collected up front. If stock finishes between strikes, this is kind of where it gets tricky. If stock finished at, say, let's say $93. Stock finishes $93. My long call, the $95 strike, what's going to happen to that? Am I going to exercise that, or am I going to let that expire without value? Well, I'm going to let that expire, right? I'm not going to want to pay $95 for stock when it's trading $93 in the market. So I'm going to let that call expire worthless. The short call that I have, the short $90 call, it obligates me to sell stock at $90. Is somebody going to want to buy that stock from me for $90 when it's trading $93 in the market? Yeah, of course, right? So my short call would get likely assigned. My long call would expire without value and worthless. Now, what do I find myself with? I've got a short stock position, short stock at $90 when it's trading 93 in the market. So I've got a $3 loss on the stock. That's offset by the $1.70 that I collected at trade inception. But I still have a short stock position and all of the risk and all of the fees and everything that go along with short stock. So that's something that you're going to need to consider. Does your trading firm allow you to hold a short stock position? If they don't, they may force you to liquidate this trade before it hits expiration. And that brings up a point that I really want to stress throughout all of these presentations and really everything that you do while you're here at the Money Show event. Talk to your brokers. Familiarize yourself with their policies and procedures. What will they allow you to do? What will they not allow you to do? How do they handle the exercise and assignment process? Are there cutoff times for their exercise window? How do they handle non-standard options? These are all questions that you want the answers to before you need them, meaning that if a situation already occurs when you need to know the answer, it's too late to do anything about it. So these are questions that you should be asking before those events happen. Right? Does that make sense? I think we can all agree on that. Potential risks of after-hours trading. This is kind of a little bit more about what I just spoke of. We're Chicago folk. So for us, the market closes at 3 p.m. Central Time for equities and most ETFs, 3:15 for a lot of the indices and some ETFs as well. But the market doesn't stop trading at 3 o'clock, right, or 4 o'clock for you East Coast folk. The market doesn't stop, right? And what that means is that after-hours trading has the potential to move an out-of-the-money contract, which as sellers is typically good for us, an out-of-the-money contract in the money. And what I mean by that is that if stock is trading $50 and I am short a $52 call, and I'm not even talking spreads, just an outright call. I'm short a $52 call, stock's trading $50. My contract is out of the money, right? I have the obligation to sell stock at $52 if I get assigned. Stock's trading 50 in the market. Nobody's going to want to buy my stock from 52 when it's trading 50. News comes out after hours, earnings release, drug trial announcement, what have you. Something that causes a material change in the stock price. And now after hours, that stock goes from $50 to $60. That short $52 call that I had is still out of the money, technically, but theoretically, it's now in the money by $8. So whereas I'm expecting to wake up Monday morning and have no position, expecting my option position to expire without value, the premium that I collected from that, I expect to retain. It's all in my account come Monday morning. That's my expectation. Instead, I find out that I'm short 100 shares of stock, or however many contracts I may have times 100, at $52, and the stock is trading 60. Right? So now I'm expecting maybe, in this instance with that I used with the spread, I'm expecting to see $170 of profit in my account and not an $800 stock loss. But the reality is that I do have that loss because of these after-hours trading. So it goes with spreads and it goes with pretty much any trading. It's also a reason that a lot of traders might close out their short positions prior to expiration. Right, 5-10 minutes before market close, they may choose to buy back a short contract, even though it's out of the money, for a nickel or a couple pennies or even a dime, what have you. 10 cents in the real world of options is what? $10, right? So meaning that $10 that you spend expiration Friday to close out that short position could save you tens of thousands come Monday. Now, we don't provide advice and we don't make recommendations, so I'm not telling you that this is something that you should do. What I am telling you is that it might be something worth considering. You can only be assigned when you have an assignable position. And I know it sounds, well, of course, that just makes sense. but people don't really think about it. You only have an assignable position when you're short options. If you close out those short options just prior to expiration, you no longer have an assignable position, and you no longer have any possibility of waking up, Saturday morning when you normally receive an assignment notice, or Monday morning maybe when you look at your statement. You no longer have that assignable position, so therefore you no longer have any surprises waiting for you. All right. Has anyone had that situation where you expected to, be flat stock, and you come Monday morning and now you're long or you're short unexpectedly because of this unexpected market movements? I saw you had your hand up. Anybody else? No one? You had it too? Yeah, you. Yeah. So, these are realities of trading, of option trading, whether it's spreads or what have you. Again, only for short options. Long options, you certainly don't have that risk because you're in control. You decide, when and whether or not you want to exercise. But for short options, you do have that risk. So one of the ways to take that risk off the table is by completely removing it and closing out those contracts ahead of time. Because once you are assigned on that short position, there's nothing you can do. We often get emails from people come Monday morning. I was expecting my position to expire without value. Now I've got all of the stock that I'm long or all of the stock that I'm short. And of course, they're not going to be winners, right? You're not going to be long stock at $50 when it's trading 75 unexpectedly. It's going to be the other way around. You're long 75 when it's trading 50, all right? So it behooves you to not only talk to your broker, again, as I mentioned a moment ago, they may manage that position for you. So talk to your broker about what their policies and procedures are for that, what their policies and procedures are surrounding exercise and assignment, because though that after-hours trading, once you get assigned, you can't do anything. The people that we talk to, the emails that we get say that, I got assigned and I wasn't expecting, and my broker won't let me do anything about it. My broker won't let me exercise my contracts. My broker won't let me manage my position. And the reason being is assignment is the very last step. Once assignment happens, there's nothing more. That's it, end of story. So it's generally a good idea to manage that risk prior to receiving that assignment, because once you do receive that assignment, all bets are off, and you just make good on the trade and you move on to your next one.